Hello viewers, my name is Ashok Sen Gupta from School of Management Sciences, Lucknow. Today topic of discussion is EBIT and EPS analysis, and we also discuss point of indifference. This topic belongs to the subject of program financial management and corporate finance in MBA. So, EBIT and EPS analysis is a part of company structure, and here we will discuss about the other things which are related to EBIT and EPS, how we can find out the best optimum structure and how we can get the indifference point. So, EBIT EPS analysis gives a specific basis for companies among the various financial plan. It shows to maximize the EPS. With the analysis of EBIT and EPS, we can get the various option to enhance the EPS with the help of EBIT and with the help of various financial structures, which include debt, debt equity mix, debt and preference share mix, and so on. So, as we know in previous lecture also, we discussed about the various plans and how we can select the best plan by using the different options which company have during its financial structuring or capital structuring. It is a tool of financial planning. EPS EBIT analysis may be defined as a tool of financial planning that evaluate various alternative of financing of project under varying level of EBIT, suggest the best alternative having the highest EPS and determine the most profitable things. So, EBIT and EPS analysis help in the project development, and in project company can analyze the project from its EPS. Through this analysis, it is a kind of tool we can find out if EBIT is same in various option, what will be the EPS? If EBIT changes, if there is any change in EPS. So, with the help of different mix, or you can say different mix of financial mix, financial manager able to understand, able to find out the profitable plan for the company. Company have received various alternatives. Important part is that which alternative is best for the company as well as the stakeholders as well as the shareholders. Therefore, it is very essential to understand the EPS EBIT analysis. Is the method that study the leverage, that is comparing the alternative method of financing at different level of EBIT. Simple out, EBIT EPS analysis examine the effect of financial leverage on the EPS with varying level of EBIT or under alternative financial plan. So, this is a method in which we can compare the various alternative of financing at different level of EBIT, or EPS EBIT analysis examine the effect of financial leverage. Financial leverage means use of debt. Financial leverage means use of debt finance to enhance the EPS of equity shareholders. It examined the effect of financial leverage on the behavior of EPS under different financial alternatives and with varying level of EBIT. EBIT EPS analysis is used to make the choice of the combination and the various sources. It also helps to select the alternative yield of highest EPS. It is useful to select the alternative source of finance, alternative source of combinations. What are the various advantages of EPS analysis? So, first advantages of EPS analysis is financial planning. Planning is a first lesson in management, and financial planning is the most important part in financial management, because capital is limited, resources are limited, and a company need to utilize its fund properly. While utilizing the fund, company also have to take care about the interest of the investors, because no company put its total fund in a project. Always they try to borrow the fund from outside sources like bank loan, debt, or they sell their stake to the equity shareholders. But in both cases, it is a duty of financial manager to take care of the benefits of the stakeholders, securities or equity shareholders. So, financial planning use of EBIT EPS analysis is indispensable for determining source of fund. In case of financial planning, the objective of the firm lies in maximizing the EPS. EBIT EPS analysis evaluate the alternative and find the level of EBIT that maximize EPS. Find the level of. So, first advantages of EPS through financial planning. Second advantages of EBIT EPS is comparative analysis. We can compare the profitability or EPS which estimated to generate from various sources of fund. EPS EBIT analysis is useful in evaluating the relative efficiency of department, product, line, market. It identifies the EBIT earned by these different department, product line and from various market, which helps financial planner rank them according to the profitability. So, we can compare a company, a financial manager, compare the usefulness, compare the best resources, best alternative among the various alternative, and from that various alternative they choose the best one by comparing this. Third is performance evaluation. So, performance evaluation is a process in which evaluation of the sources of fund and then if the selected fund provide us right kind of return, then we judge it, give them high rank, otherwise we think about the other alternatives. So, performance evaluation, comparative evaluation of performance of various source of fund, it evaluate whether a fund obtained from a source is useful for the project and high rate of return than its cost. So, we can compare the performance of the fund, we estimated performance of the fund and compare it. Every source of fund have its own cost, and every company, every firm would like to gain out of its investment, out of its project. So, whatever the source of finance the firm has chosen, they would like to get some benefit or gain out of this, that is return. So, if return is higher than cost, then our fund is performing well, our financial source or financial source of fund performing well. Otherwise, we need to think more and choose the another one, but it is a capital expenditure, it is in capital structure. So, it is very difficult to shuffle from one alternative to another alternative, because it is quite time taking and it is involve already more costing. So, on first stage a financial manager must analyze the performance, and how? By estimating the things, like whenever we want to select, either we go for the equity, either we go for the debt, we know that debt is cheaper source of fund. So, how much ratio of debt equity must be in our firm? If we want to go for the equity preference share also, so what will be the ratio? So, firm, the financial manager, the top bosses all know what they want to pay to the investors, that they cost. Secondly, if they go for the bank loan, it is quite open, the rates. We all know the, we can all able to find out the different bank rate. Bank rate means interest rate on loan. So, by comparing the interest rate and our estimated returns, we can able to find out the performance of the sources of fund by EBIT EPS analysis. Fourth is determining optimum mix. So, optimum mix means the ratio of debt and equity, which gives maximum EPS, simple. So, it is optimum. What will be the debt equity ratio, and the debt and impact of debt equity ratio on earning per share, So, this is a quite analytical thing, how we can use the debt equity ratios in a firm in different year, or you can say a spare of time, 2 year, 3 year, 5 year, and judge the performance and find out the optimum ratio. The optimum mix always helpful when the companies earn more profit for the equity shareholder, earning per share. The equity shareholder will get delight when they find that their EPS is increasing. While company is using debt, their EPS is increasing. It is more delightful factor, because when we using the debt, equity shareholders always feel risk. They always feel risk that their earning will distribute towards to the equity shareholders. So, debenture holders. So, therefore, it is quite important to understand that the optimum mix, and where the companies have the best choice, 2:3 ratio, 1:2 ratio, what will be the ratio? That is the best optimum mix. With advantages, there are some limitations also. So, first limitation is no consideration for risk. Leverage increase the level of risk, but the technique ignore the risk factor. When corporate on its borrowed capital earn more than interest has to pay on debt, financial plan can be accepted in respect of risk. But in time of poor business, reverse of the situation areas, and the degree of risk high. In previous classes, I also discussed this point lot of time. Think about that, a company having a theory, company use a theory of using debt. Okay. Company using a theory that they use debt as a source of finance, and they want to increase their EPS of the shareholders. Okay, fine. Now, what happened? Let us see, company earning a good profit, at that time they able to pay the interest to the debenture holders. See, with this example, like 10% debenture, that is interest rate of debenture have to pay 10%. Okay, fine. Now, company earn, for example, 2 lakh rupees, 10% of 2 lakh, 20,000. This is fixed, 10% is fixed, 20,000. So, they have to pay 20,000 from the profit to the debenture holder, remaining balance after paying the tax to the equity shareholders. But assume that if company not earning good, company is not earning good amount of profit, even though they have to pay the fixed percentage of debenture interest to the debenture holder. In this condition, if profit moves down to 1 lakh rupees, then in this case also they have to pay 10,000 to the debenture holders, and from remaining 90,000 they have to pay the taxes, and remaining balance to the equity shareholders. So, in this case taxation is fixed thing, is fixed. Fixed means you need, if you earn, then you have to pay the tax. If you earn loss, you do not need to pay the tax. But in case of losses also, you have to pay out the interest on borrowings. They need to pay out the interest on borrowing, like on debenture holders or long term borrowings. You need to go bank loan, you need to pay. you need to pay. So, this is the quite risky situation, and most of the time it limitation that we are ignoring the risk, we are not considering the risk. We said that we have to add debentures, give the leverage, but addition of debenture is up to the certain limit. Next limitation is contradictory as a result. It gives a contradictory result where under different alternative financing plans new equity shares are not taken into consideration. Even the comparison amongst the difficulties, if the number of alternative increases and sometime not give errors result under such situations. So, different alternative financing we are using, but sometime the financing of alternative sources give the different results, and contradictory result. So, this is quite limitation of the EPS EBIT analysis, and even in time of comparative study or comparison, it is difficult to compare the alternative sources. Next is over capitalization. It is also difficult thing. Over capitalization because beyond to certain point, if you having the additional capital, we cannot use the capital and it is difficult to pay the EPS. Yesterday I saw the result of IPO of one of the company. Is it oversubscribed and overcapitalized? Means more and more people purchase their IPO. Similarly, when company borrow more fund, overcapitalize themselves, then it is difficult to manage the capital, because capital is a thing, if you not use it properly or in time, then it is quite waste for us. Additional capital must be used properly, so it gives you additional return rather than it can also decrease the EPS. So, formula of EPS, as we know, operating profit divided by number of shares. If number of shares increases by issuing more and more equity shareholders, but our operating profit remains same, then earning per share will decrease. So, this is the limitation of overcapitalization, where we are not able to use the fund properly, we do not make balance between the debt and equities. So, let us do a simple numerical. A Limited has a capital share of 1 lakh divided into share of 10 rupees each, that means total number of amount is 10 lakh. It is a major expansion program required to invest 50,000 additional, 50,000 रुपये से additional चाहिए थे expansion के लिए. Management is considered the following alternatives for raising the amount. Management ने अलग अलग alternatives चुना to raising the amount. So, first alternative is issue of 5,000 shares of rupees 10. This is the first alternative, issue of 5,000 shares of rupees 10. Second is 5,000 12% preference shares. Next is issue of 10% debenture of 50,000. EBIT is given and tax is also given. So, we have a different alternatives and we can do the same when when EBIT is continue for same and EBIT increase by 10,000. EBIT अगर 10,000 बढ़ जाता तब क्या होगा EPS में और सेम रहता क्या होगा. So, let us see, this is the EBIT and we already did the same kind of question less the interest because it is a dividend part, interest part. After tax, after paying the tax, for this is tax, after paying the tax, profit for the equity shareholders, number of shareholders this, and this is the final EPS. So, here we able to find out the mix is must be plan 3, the mix must be plan 3 because we have a highest EPS. In second plan, if the earning is 50,000 more, then we also find that by adding the debenture, our EPS is increases. So, it is our best mix is plan 3. Now, let something discuss about the indifference point. The indifference point is a point where we are planning have different sources and we are get a optimum figure like break even. So, indifference point called a break even point is highly important financial one because EBIT amount is excess of the EBIT indifference level. The more heavily leveraged finance plan to get generate in high EPS. On the other hand, EBIT about below gives the financial plan involve the less leverage generate the EPS. Indifference point refers to the EBIT level at which EPS is same at two alternatives. So, given by the J.C. Jones, it is the kind of break even point where we able to find out the if EPS is same and what will be the EBIT different alternatives or and that alternatives of EBIT if we get the same EPS. So, what plan we must choose. Indifference point is a cutoff level of EBIT below which the leverage is disadvantageous and below above that it is advantageous. Indifference level of EBIT is significant because a financial planner must decided to take debt advantages to expected EBIT return. On the other hand, financial leverage will be favorable beyond the indifference level point and it will leads to increase the expectation. So, if the expected EBIT less than the EBIT, it will be more difficult or it will be more leverage. So, this is the point and this is the point here we have two plans and in this plan we getting the same kind of EPS, we getting the same kind of EPS. So, this is a factor and at this level we choose the EPS. So, indifference point is the point where we get a same EPS at different financial plans, okay, different financial plans. So, this is simple theory of indifference level. Okay, my dear friends, I hope you understand this video and about the indifference point and the EPS EBIT analysis. Thank you for watching this video.